Welcome to our video on reading between the lines, the ultimate guide to spotting red flags in balance sheets. Balance sheets are an essential component of financial statements and are a window into a company's financial health. However, they can also be misleading if not read correctly. Therefore, it's crucial to know how to spot red flags in balance sheets to make informed investment decisions. In this video, we'll provide you with a comprehensive guide on identifying red flags in balance sheets. Before we dive deeper, let's define balance sheets. A balance sheet is a snapshot of a company's financial position at a specific point in time. It shows assets, liabilities, and equity, providing an overview of a company's financial health. However, it's not enough to only look at the numbers presented. It is essential to read between the lines and identify potential problem areas. Understanding balance sheets. To read between the lines of balance sheets, we need to understand some basic concepts. Balance sheets are based on the fundamental accounting equation, which states that assets must always equal liabilities plus equity. This equation is the foundation of every balance sheet. Assets. Assets are resources owned by a company. At high level, they are classified as current or non-current. Current assets are items such as cash, accounts receivable, and inventory, assets that can be easily converted to cash within a year. Non-current assets are items such as property, plant, and equipment, assets with a longer lifespan. Liabilities. Liabilities are obligations or debts a company owes. Like assets, they are classified as current or non-current. Current liabilities are those that have to be settled within a year, such as accounts payable, short-term borrowings, and taxes payable. Non-current liabilities are those that are due longer than a year, such as long-term loans. H4. Equity. Equity is the residual interest in the assets of a company. It represents the portion of the company that belongs to the owners or shareholders. The equity section of a balance sheet includes items such as share capital, retained earnings, and reserves. Red flags. Warning signs in balance sheets. Now that we understand balance sheets, let's look at some red flags that investors should be aware of before making investment decisions. Inflated assets or income. One common tactic used to manipulate financial statements is inflating asset or income values. Companies may overstate the value of assets or revenue to give the appearance of a stronger financial position. This can be a warning sign that the company is in poor financial health and trying to hide it. High debt-to-equity ratio. A high debt-to-equity ratio can indicate that a company is heavily reliant on debt to finance its operations. If the company's debt is significant compared to its equity, it can be a warning that the company is in financial distress. Evaluating the trend of debt to equity over time can help investors understand the company's financial situation better. Negative cash flow. Negative cash flow occurs when a company's cash outflows exceed cash inflows. This can be a warning sign that a company is struggling to generate enough cash to pay its debts and other expenses. Examining the company's cash flow statement, specifically the cash flow from operations, can help identify the problem better. Unusual changes in inventory or accounts receivable. Unusual changes in inventory or accounts receivable can be a warning sign that the company might be inflating revenue or understating liabilities. For example, if inventory levels suddenly spike without an increase in sales, it can indicate that the company is having difficulty selling its products, resulting in an inventory buildup. Unreported off-balance sheet items. Off-balance sheet items are significant arrangements that aren't recorded on the balance sheet. Examples include leases, contingent liabilities, and special-purpose vehicles. These items can significantly impact the financial condition of a company, and investors need to be aware of them. In conclusion, balance sheets are crucial in determining a company's financial position. However, reading between the lines and identifying warning signs can be challenging. By understanding the fundamental accounting equation, assets, liabilities, and equity, we can identify red flags such as inflated assets or income, a high debt-to-equity ratio, negative cash flow, unusual changes in inventory or accounts receivable, and unreported off-balance sheet items. As investors, it's crucial to keep a watchful eye on the balance sheet and other financial statements to make informed decisions. We hope you enjoyed our guide on reading between the lines, the ultimate guide to spotting red flags in balance sheets. Thank you for watching.